We're still, the CAPE ratio right now is around 25. It's high. 10 years, yeah. That's much longer than most business cycles, so it averages out over the business cycle. The ordinary price-earnings ratio is misleading because earnings can drop precipitously in a recession, and they're volatile from year to year. So we just take a long average. It's not a new idea. You know, you find it, beginnings of this in Graham and Dodd in 1934. It's been mentioned over the time, but it's never become a standard. It should be a standard. It's a standard of valuation for the whole stock market. Something like 11,000 on Dow and 1,300 on S&P 500.
That is
quite a bit lower. Nobody can really forecast the market accurately, but I think this is a risky time. I think there is a risk of substantial declines.
We've seen a number of emerging market crises during the last 30 years. 82, 97, and 98 were classic ones, and they usually occur at periods of intense dollar strength. And I think, unfortunately, this time is different, and different in a bad way. We're the reserve provider. We have to provide the world with sufficient reserves so that their GDP can grow. So if India's growing at 5% per annum, she needs 5% more oil. And she has to pay for those in dollars. So we supply those dollars via either importing goods from abroad or exporting capital, so to buy investments overseas. And the big thing that's changed structurally in the last decade has been the emergence of the shale industry in the US, and it's substituted what we import for energy. And it's structurally changed the current account, and it's leaving the world woefully short of dollars. And that's currently the problem that we're having. This is what's hurting emerging markets.